discuss taxonomy and value capture in a world of liquid assets. Please welcome partner at Placeholder, a crypto venture capital firm, Chris Burniske.
Hello, everyone. I'm excited to be here. I'm happy to be here. It's a privilege to speak on a Saturday morning because I know everyone who's here is committed. So thank you for showing up. I am going to be talking about taxonomy and value capture and a little bit more. So I'm going to start off with a conversation around beliefs, really because beliefs are what shape what humans believe and what humans do. And there is no conception of a dollar, for example, in the natural world. A tree has no conception of a dollar. It's really we humans that choose to believe in the concept of a dollar and therefore coordinate around it. And of course, we are reshaping how we coordinate with crypto. I'll then get into crypto commodities, crypto capital, and then I will talk a little bit about existing assets in a liquid future and finish with the fact that we should expect speculation to lay the foundation for innovation. So starting with beliefs, this is a piece that I wrote last year called Theory Follows Price, Price Follows Theory. And what I'm trying to get at here is that we as humans, we as animals, observe naturally occurring phenomenon or artificially occurring phenomenon and then work to explain them. And specifically within the financial markets, and within the crypto markets, we are seeing prices. We are creating theories to explain those prices. Those theories are in the form of quantitative models that then we backtest. And if the backtesting looks promising, then we start to use them to forecast. And the acid test of a theory is whether it can effectively forecast. And if a theory consistently forecasts with accuracy, then that theory will start to lead price. And so this is where we go from starting off with theory following price to then price starting to follow theory. And it's a bit of a mind trip because it means that the future bends into these theories. And so for any of you that have worked in the equity markets, this is just the way it works. Analysts create financial models that predict a quarter out or a year out or whatever it might be. When I was at ARC, we would predict 5 years out. And then those models are used to predict the future, and in predicting the future, they pull asset prices with them. Now, if there's a change in the reality and the data that goes into the model, then there's a repricing. But it is all theory-based. It is all human-based. And more broadly, we as humans coordinate around shared beliefs. And the reason I'm starting with more of a philosophical bent to what should be a very quantitative talk is because we get to reprogram this software in our minds that we all believe in on a regular basis. And so the idea, again, of a dollar or of any quantitative model, it's not a naturally occurring phenomenon. It's an idea that someone came up with at some point that then convinced other people that had merit, and so we all moved forward in that direction. And I think with crypto, one of the most promising things is we get to reshape how a global economy coordinates around values and therefore value. And the two are very different, and we need to be intentional about how we do that. Now, moving into the more practical stuff, crypto assets don't have to necessarily reshape what society values in order to have value. In fact, crypto assets fit within the current belief system of capitalism in that if they coordinate and capitalize networks that produce valuable resources, they will accrue value over time. These networks are means of production, just as a company is a means of production. And there are going to be different models that we use to quantify the value of these assets in the way that they coordinate those means of production. But if they're producing something that's valuable for society, they will accrue value. It's not radical. It's really just cut and dry economics. So things that the crypto market currently appears to be believing that has value, I would segment into crypto commodities and crypto capital. And to set these in a bit more of context, I'm going to use these superclasses from a paper from Robert Greer called What is an Asset Class Anyway? And he outlines 3 superclasses of assets. So these superclasses actually sit above what we traditionally think of as asset classes. There's capital assets, which produce an ongoing source of something of value. They're valued on the basis of the net present value of its expected returns. So taking all future value flows and discounting them back to the present, these would be things like equities, bonds, income-producing real estate. The next superclass would be consumables, transformables. So these you can consume, you can transform into another asset, it has economic value, but it does not yield an ongoing stream of value. And that's a really important difference from a capital asset. And so these would be things like oil, wheat, natural gas, so on and so forth. The third bucket are store value assets. So they cannot be consumed, nor can it generate income. Nevertheless, it has value. It is a store value asset. And so we have things like art or wine that go in this bucket, some precious metals. Interestingly, something like gold would fall between a consumable, transformable, and a store value asset. So I've set this context, and we're going to come back to this slide a number of times to see how different crypto assets fall within or between these superclasses. So crypto commodities. This is really where crypto started with Bitcoin. I would argue that anything that is proof of work based and created is a crypto commodity. And a subset of them will become commodity monies where they have a strong financial premium. So for example, Bitcoin falls across the consumable, transformable, and store value bucket. It has a utility. It gives you access to this secure, globally accessible ledger space. But its market price is above and beyond its consumable, transformable value, just as gold's market price is above and beyond its consumable, transformable value, because it is considered a store value asset. And that pricing that financial premium is maddeningly hard, because it goes back to just what we collectively as a society are choosing to believe this asset has as a financial premium. Other proof of work assets that don't end up developing a financial premium can be purely consumable transformables. They'll suffer likely from the velocity problem, because much less of them will be held as a store of value, and they won't be perceived as scarce. That's not to say they won't create value, it's just to say that they will capture less value. And a strong determinant often of a store of value asset is this idea of annual supply inflation. And annual supply inflation is just saying how much each year is produced as a percent of the existing base. So if we look at something like gold, its annual supply inflation has been between 1% and 2% for the last century. And it's existed for a long time, so it has a very large base, right? Where you look at something like silver, you're more in like the 20% range. You look at something like wheat or oil, you produce 100% of what was existing as stock in any given year. And so the lower your annual supply inflation, the more predictably you can know that the units I have today are going to be a pretty good percentage of the units that exist 10 years from now. And so this is where time-consistent monetary policy becomes really important for anything that wants to become a commodity money. Okay, quantitatively, how do we value these things? I've put forth that we use the equation of exchange, MV equals PQ, to do this. I first put this out in 2017. There have been a lot of people who have extended the model with a lot more granularity than I originally did. And really, all this is saying is on the left-hand side of the equation, you have the size of the monetary base multiplied by the velocity of the money. And that's often referred to as the demand side. So that's how many times does the money turn over in a year, and therefore, what is the aggregate value of money that turns over in a year? And that is equal to PQ, which is often referred to as the supply side, and P being the price of goods and services offered in the economy multiplied by the quantity of those. So the supply of what's produced needs to match the demand of the money that circulates in the economy. And what you end up doing here is you solve for the necessary size of the monetary base, M equals PQ divided by V. You have to do this into the future. I haven't included all the details of the model in this talk today. There's a lot of online resources if you're curious about going deeper. What's interesting, though, is Bitcoin has proven to us a few things within this crypto commodity and crypto money idea. one, it is the mother of crypto, and so we have to give it credit for that. And in being the mother of crypto, it has become the bloodline of liquidity, meaning that because it was the first crypto asset that existed, it was always used to price and trade all other crypto assets. And in so doing, it has become the unit of account, it has become the reserve asset. And that is a really important point, and it proves the commodity theory of money really well. The last thing I would say about Bitcoin, this is almost so consensus now, whereas even just a few years ago it was not, but this idea that scarcity matters in a digital world. You go back to 2014, 15, there was not this consensus belief that something that is digital could have scarcity that people would buy into. Whereas now, you can be in crypto, you can be in the traditional financial markets, and that's no longer feels like a battle that we're having anymore. So that's an important thing that Bitcoin has proven to us, and it will get more important with time. This tweet put a smile on my face. A single garden variety metallic asteroid contains more gold than has ever been mined in the history of the world. And so this proves the idea that actually we can have perfect scarcity in a digital world, and in a digital world only. Because in a physical world, we can always produce more of a commodity. If we think we've run out of it on planet Earth, there's a whole universe to explore. And so going back to humans believe the things they want to believe, and actually we have created all of the value that we see in the world collectively with our minds, I would argue that digital scarcity will supersede physical scarcity as we go into the future. If Elon Musk's and the Bezoses of the world make us a spacefaring society, then the importance of digital scarcity will only become greater and greater. With that, I'm going to turn to cryptocapital. And the reason cryptocapital has become really relevant is because while a lot of early altcoins followed proof of work, we're currently seeing an explosion of stake-based assets. And this can be stake-based assets like Ethereum 2.0, really as layer 1 consensus, or it can be more economic stakes, so something like LivePeer, where you are staking the asset in order to be a supply-sider providing the service of the network. And I would argue that anything that is staked, bonded, or otherwise committed in order to get a claim on the value flows is a capital asset. And this is a really important point. Because what I'm saying is proof of work assets are commodities, and they're going to be valued very differently using MV equals PQ from something that is a capital asset. Because capital assets have a claim on a value flow. Me holding Bitcoin, I don't have a claim on anything. I, as a miner, don't have to have any BTC in order to produce that service. I may get paid a little BTC, but I can very quickly sell it. And so this is a really important delineator, and I expect the majority of crypto assets in the market to eventually be capital assets if we're not there already. And so what does that mean? That means that we actually have a lot of crypto assets singularly being capital assets or falling across the capital asset consumable transformable bucket. And the hybrid, what I've highlighted as ETH 2.0 there, is really interesting because we haven't really seen these in the wild before. We've seen, as I said with gold, things that overlap consumable transformable store of value, but this idea that you have a capital asset that is capitalizing a system but then also providing utility within that system is somewhat foreign to us. I'm going to get into how we value it in the next slide, but the other thing I would point out is I think we'll have pure crypto capital. And these will be assets where maybe the demand side is not actually paying in the native asset of the network, but could be paying in a stable coin. And so there's no actual utility for the asset beyond just being a supply-side coordinator. It's still different from equity, and I'll come back to that too. So these crypto capital will take inspiration from its capital asset peers, and as a productive asset, something that throws off value, its value will be calculated as the net present value of annual value flows to supply-siders. Again, very different from MV equals PQ. And this is much more familiar, actually, to traditional capital market analysts. And so it starts to feed back into the theory follows price, price follows theory movement, because as we get more analysts that understand what's driving value, they will create more models. Those models will do a better job of fitting past data, eventually forecasting future data, and so we, as collective market participants, will converge upon consensus models more quickly. A few nuances within this. Often people will say, well, if it's crypto capital, it's just an equity. I don't think that's the case at all. I actually think it's a new form of capital asset within the superclass of capital assets, but it's not an equity, it's not necessarily a bond, it's not necessarily income-producing real estate. And there's a few reasons for that. One, if you think about an equity, so I run a VC firm, and if I as a VC were to capitalize a equity-based company with an eye on the cash flows, I could forevermore have a claim on those cash flows. Certainly I have to participate through rounds, but once the company goes public, I forevermore have a claim on those cash flows, and passively so. I don't have to do anything. And I didn't grow up thinking I would be an investor or work in the financial markets, and when I just step back and I look at that, it sounds too good to be true. It sounds unfair. Because I don't understand why a financier should have a claim on something forever if they're no longer contributing to that effort, say, 20 years from now. And this is very different from how crypto capital works. In order to get a claim on that value flow, you have to be an active participant. And so it really starts to separate out, okay, are you actively contributing your capital and labor to this network? If you are, then you are receiving value. If you're inactive, then you're just getting diluted. And I would argue that is a much more egalitarian construction and better way for us to coordinate the production of services in our world. How demand-siders end up factoring into crypto capital is less explored. But again, intuitively, when we look at our equity-based systems, we all work for Facebook. If you're using WhatsApp, if you're using Instagram, if you're using Facebook desktop, you're working for Facebook. And yes, it's very obvious and it's been talked about for a long time that we don't get paid for that work. We don't really have control over our data. All of this is, I would argue, unfair. But the idea that when you are contributing capital and labor to a system, you should be getting compensated for that. Again, intuitively, it just feels right. And there's no reason to say, oh, well, equities are always just going to be the way they've been. Again, equities are a belief system. They're the means we've chosen to coordinate ourselves for the last 400 years. But 400 years, even in the context of Homo sapiens, is a very small slice. And so we should expect to continue to upgrade these systems over time. A last question that I have around the crypto capital bucket and ETH 2.0 in particular, and this came from a conversation on Twitter, is could ETH 2.0 actually fall across all three superclasses? And the way this would work is you would have the capital asset net present value of value flows to supply-siders. You would have MV equals PQ as the consumable transformable utility. But then you would still have a financial premium. You would have a financial premium on top of what the capital asset can explain, or on top of what MV equals PQ reliably explains. I, for whatever reason, hesitate to say this. I prefer to say, it'll be a capital asset with some utility, and really the majority of its value will come from that capital asset characteristic. But my belief, not necessarily going to be all of our beliefs, and the models will tell the truth over time. I'm going to switch for a little bit to the existing capital market assets and how they're going to play into this movement. One thing I'm really excited to see happen, and is already happening before us, is we get to take all of the learnings from the equity markets, from the bond markets, from the real estate markets, and apply them to this tabula rasa that we have in the digital world. And what that means is if we go back and look at how equities or bonds matured through the 20th century, the technology was maturing, the regulation was maturing, and they were largely built as silos. And there is interoperability between them, but if I look at myself as an end user, I have my bank account for fiat, I have my brokerage account for equities, I have my bank that gives me my mortgage for my house, and they're all kind of separate views. Whereas what I expect to happen within the crypto space, and as we segment out what a wallet means, any crypto wallet is going to be able to hold all of the world's assets. Now, I think you will have a vault where you keep the majority of your wealth. You will have a disposable wallet, which you're actually okay losing. But what is going to be really fascinating is that the same wallet, the same interface can hold all of your assets. And so what that ends up doing to the liquidity as we break down these asset fiefdoms is going to be really interesting. And Steve McKeon, one of the leading thinkers around security tokens, pointed out to me a long time ago that we could have booms in illiquid traditional assets as their liquidity increases. Things that are more liquid, basically when something's illiquid, you discount it because you don't know whether you're going to be able to get a true or fair market price when you go to sell it. And so if it gets more liquid, if there's better price discovery, then you could actually see it increase a little bit in value and unlock some of the world's value that way. So I think that's really interesting. I encourage us to stop fighting with each other. Maybe I spend too much time on Twitter. But the constant sort of fighting intra-crypto, I think, is counterproductive and frivolous. There is a massive value world out there. These numbers are even outdated. But Bitcoin's going after gold, 7.7 trillion. Stock market, 73 trillion. That's probably more around 100 trillion. So on and so forth. Monies are a relatively small slice of that value pie. Still a very big slice. But this is what we're going after, and this is what we should be focused on. And there's so much opportunity in the value pie that I think fighting within the very small value pie that is currently crypto is kind of ridiculous. Just a small sign of traction that I think is going unnoticed. So I spend majority of my time on native crypto assets, but the security token movement, this caught my eye just from the start of this month, that companies raised $442 million in 2018, up 20x from 2017. And I feel like very few people took note of this or even talked about this. Telltale sign of a bear market when you've got big numbers, high growth like this, and it's kind of a non-event because everyone, I guess, is sad about the money they lost. But good sign of traction. Speaking of losing money, we should expect for the speculation to continue. And speculation actually lays the foundation for innovation. And capitalism itself is inherently speculative. Every single asset is priced, is valued based on the future, not the present. The future is speculative. We can't possibly know it. And being the future, it's going to have a lot of human emotion in it. We're going to overproject. We're going to be overly optimistic when everyone else is overly optimistic. We're going to be overly pessimistic on the flip side. And so this is a very predictable pattern that has happened really for as long as humans have had the belief system of financial markets. And so here is what one potential reality looks like going to the end of 2021 for Bitcoin. So x-axis, we have January of each year, January 2009 all the way out to January 2021, January 2021 being Bitcoin just through $1 trillion. And the way I created this graph, this was actually using April data, is I just took April data actually from 2015, and I did day over day percent changes in Bitcoin's network value from April 2015 to the end of 2017. I then cut those day over day percent changes in half. I said the future will be half as volatile as the present. Bitcoin has been de-risked. We can expect it to be less volatile, just a heuristic. And then I compounded it out. And so that's why I titled this Bitcoin's network value end of 2021 if the future is half as volatile as the past. Now, if you expect the future to be equally volatile, then the graph would be even more insane. But the reason I'm putting this up here is, yes, whenever we are in the heat of the next bull market, the media will be in the frenzy. There will be a lot of new people entering the space that are in a frenzy. But it is incumbent upon us that are here today to remain rational, cool-headed, be prepared. While speculation is inherent to capitalism, we shouldn't encourage irresponsible speculation. And so, just painting what the future looks like or will likely look like so that we're not surprised when we get there. Now, to put Bitcoin at $1 trillion in context, If we take Bitcoin at $1 trillion, and again, using a rough heuristic, say Bitcoin's dominance index is at 33% because this dominance index has been falling over time. Yes, the dominance index rallies in bull markets, falls in bear market. Rallies, the Bitcoin dominance index goes up in bear markets as Bitcoin is the reserve asset, people retreat to it, but the dominance index goes down in bull markets as the more speculative, newer experiments within crypto are higher beta and basically rally faster than Bitcoin does. So if BTC is at $1 trillion, and let's say the dominance index is at 33%, then we could have all of crypto at $3 trillion by the end of the next bull market. And so placing that in the context of the web bubble burst at 2.9 trillion non-inflation adjusted in 2000, 4.4 trillion inflation adjusted. And so, we're starting to get into that range. This is actually placed in the framework of an economist by the name of Carlota Perez. She wrote an amazing book called Technological Revolutions in Financial Capital, which I highly encourage you read. It's 160 pages of gold, and it lays out a lot of what we can expect to see in crypto in the years to come based on hundreds of years of past technological revolutions. And I would just place us, this is actually a placeholder slide that Joel, my partner, designed, place us in the frenzy. So we'll be entering the second bull market of the frenzy in the year to come. Some people would argue it's already started. Now, just because the bubble might be as big, the technology might not be as mature as where we were in the late 90s or 2000 for the web. And I would argue there's a few reasons for that, but one is with crypto, we're tinkering with both the technology and the structure of finance. With the tech and telecom boom, we tinkered with the technology, but we mostly use the existing structures of finance. And so in tinkering with the structures of finance, there's bound to be a lot of bad behavior, a lot of good behavior. But humans will inevitably get ahead of themselves. And so this is one reason why I think the bull market could be just as big. There are other things like we have the internet upon which information spreads. And the internet revolution didn't have the internet to propagate itself upon. So crypto is really the first revolution of this kind that I would say has the internet to spread like wildfire with. Now, speculation will continue, and in the frenzy, you characteristically divorce from reality really violently. But after the big crash, again, after we get more consensus models that come in, things will start to settle down. We will start to have better price discovery. There will still be volatility. There will still be booms and busts, but they should temper with time. Last slide. This goes back to the start. This goes back to actually where we began in crypto. It was a myth. There were very few people who believed in it. Satoshi Nakamoto still remains an unknown character, but it has evolved over the last 10 years into a strong belief that I would say most of the people here today hold. Now, it's still a belief that is held by the minority of society. But what's so fun about this is we get to propagate this belief. And beliefs actually change with generations, right? And so while we may have the Jamie Dimons ranting against Bitcoin, Jamie Dimon is nearing the end of his career as we have a rising generation that gets to choose what it wants to believe. And there are also these very predictable, there's another book I love called Generations, these very predictable swings in generations where really generations work against what the prior generation did. It's just the way we are as humans. We want to do new things. We want to do different things. We want to be different. And so even Jamie Dimon in his actions actually catalyzes us to further believe in what we are doing with crypto. And so we have gone from being a myth to a strong belief, and our next step will be going from a belief to a societal truth. And when we're at the societal truth is where crypto is the new default, and it'll actually be rather boring. I think we'll look back on these days, these colorful days, and wish for them, because we're in the period of anticipation. It's when things are exciting, things are unknown, and actually once you get to the new default is where it's just kind of mundane again. And then at that point, some new generation will be creating some new thing that's even better and brighter than crypto. No idea what that will be, but I'm excited to see crypto become our new truth. Thank you, everyone.